Stop for a moment and consider the most valuable thing you own: your house. Your entire investment portfolio, perhaps 10 years of your salary. Now imagine trading all of that, every single asset, every piece of stability, for a single flower. Not a diamond, not a piece of land, but one variegated tulip bulb. This is not science fiction. It is the absolute documented historical reality of the year 1637 in the Netherlands. For a brief, terrifying span of months, a single Semper Augustus tulip bulb was routinely traded for the price of a luxurious house in Amsterdam, or 4 fully loaded carriages, or even 12 acres of prime farmland. This wasn't merely a speculative craze. This was the complete, total collapse of human reason, fueled by an intoxicating rush of easy credit. It was the first definitive blueprint for every modern financial bubble. And what Tulip Mania teaches us about the absolute delusion of credit is the only knowledge you need to protect yourself from the collapse that is already brewing today. This is the story of the flower that ate an empire's sanity. To understand the absurdity of the tulip, we must first understand the ground it grew on: the Dutch Golden Age. The Netherlands in the early 17th century was the wealthiest nation on earth, a global commercial hegemon powered by the Dutch East India Company and massive maritime trade. Gold was flowing, profits were immense, and importantly, the financial infrastructure was the most advanced in the world. This era provided the seed for Minsky's theory: stability bred instability. A vast class of newly wealthy merchants and investors had capital they were eager to deploy. The markets were safe, reliable, and growing, the perfect environment for hedge finance to take root, creating an overwhelming sense of confidence that convinced everyone that risk was obsolete. The tulip itself was introduced to Europe from Turkey and immediately became a status symbol. It was exotic, rare, and beautiful. But the real frenzy began when the bulbs became infected with a harmless virus, the mosaic virus that caused the petals to break, creating unique, striking, flame-like patterns. These variegated bulbs, like the Semper Augustus or Viceroy, could not be reliably propagated, making them genuinely rare. Their beauty made them fashionable. Their rarity made them expensive. But the crucial shift from gardening passion to financial madness occurred when the Dutch market innovated new financial instruments. Because the bulbs could only be transferred physically between June and October, when they were dormant, traders began using futures contracts promises to deliver a bulb at a future date during the winter months. This innovation was a game-changer because it eliminated the need for physical possession or even initial payment. With futures contracts, you could now speculate on a tulip's price with only a small margin payment, or often no payment at all, just a handshake and a promise. This is where the debt cycle truly accelerated its descent into madness. The market shifted from hedge finance, where merchants used their actual savings to buy a few bulbs, to rampant speculative finance. Suddenly, every baker, shoemaker, and chimney sweep could enter the market. They weren't interested in the flower's beauty. They were interested in its price trajectory. They took loans from notaries or leveraged their existing assets to buy more and more paper promises. They were relying entirely on the price continuing to rise, allowing them to sell the contract for a profit and roll over the loan before the final delivery date. The market was no longer driven by trade or utility. It was driven by the expectation of an infinitely greater fool waiting just around the corner. As the speculation reached its fever pitch between 1636 and 1637, the market entered Minsky's terminal stage: Ponzi finance. People were borrowing money not just to buy bulbs, but borrowing to cover the margin calls on contracts they couldn't afford. The price of a single bulb could double in a day, sometimes in an hour. Buyers were taking out mortgages on their homes, and merchants were liquidating entire businesses to join the frenzy, believing that physics and economics had been suspended for the glory of the tulip. At the very peak, a rare Viceroy was valued at the equivalent of 24 tons of wheat, or enough beer to supply a major city for a week. The value was entirely divorced from reality, secured only by the collective delusion that the prices must go up because everyone believed they would. The debt instruments were everywhere, promises layered upon promises, secured by nothing but hope and the assumption of eternal liquidity. The Minsky moment arrived not with a bang, but with a slight, almost imperceptible chill. In Haarlem, on February 3, 1637, a routine auction of bulbs failed to attract bidders. It was a minor event, but the confidence, the bedrock of the Ponzi structure, shattered instantly. When the first contracts went unsold, Speculators realized, with horrifying clarity, that there was no greater fool. The realization was collective and instantaneous. The price drops started slowly, but because the entire market was built on paper and leverage, the collapse was total. Everyone tried to sell their contracts simultaneously, but suddenly, the promised future delivery was worthless. Buyers defaulted on their future contracts, which triggered the default of the speculators who had taken out loans based on those future contracts. The contagion spread. Notaries were ruined, banks faced insolvency, and merchants found their life savings replaced by worthless paper promises for flowers that were still in the ground. The economic shock was profound. While the Dutch economy eventually recovered, the damage to social trust and individual fortunes was immense. The timeless lesson of Tulip Mania is this: the object of speculation is irrelevant. Whether it is a tulip, a .com stock, a subprime mortgage bond, or a digital token, the mechanism of the bubble is always the same. It is the insidious transition from saving, hedge finance, to aggressive speculation, speculative finance. Fueled by the invention and widespread use of easy credit instruments, the futures contract then, the leveraged derivative or easy crypto loan now. The human emotional engine greed and the fear of missing out is constant. The moment the asset price is discussed in relation to its price movement, rather than its underlying utility or value, you are already deep in the credit delusion that leads to the Minsky moment. If tracing the architecture of this first great bubble provides you with the clarity to spot the same warning signs in today's frenzied markets, I strongly encourage you to subscribe. By subscribing, you arm yourself with the strategic foresight necessary to navigate the cycles of financial delusion and avoid being the greater fool in the next inevitable collapse. Next time, we will take the lessons of speculative finance and apply them not to flowers, but to the most powerful debt machine in history. We will examine the definitive case study of sovereign debt collapse, moving from the private frenzy of the Dutch market to the public failure of a global superpower. Join us as we explore the consequences when the silent tax is no longer enough, when Rome defaulted, the economic lessons of an empire eaten by debt. You will not want to miss this vital chapter.